Welcome back to the channel, and if you're new here, make sure to hit that subscribe button, because today we're rediving deep into one of the most talked about fintech stocks in the market right now, SoFi Technologies. Now, if you've been watching the stock market lately, you've probably noticed SoFi making some serious moves. And the question everyone's asking is, should you be buying, holding, or staying away? By the end of this video, you'll have a complete understanding of where SoFi stands, what's driving the stock, and whether it deserves a spot in your portfolio. So let's get right into it. First, let me give you some context about what SoFi actually is, because a lot of people think it's just another student loan company, and that couldn't be further from the truth. SoFi, which stands for social finance, started back in 2011 as a student loan refinancing platform. But over the years, it has completely transformed itself into a full-scale digital banking ecosystem. We're talking about personal loans, mortgages, investment accounts, credit cards, banking services, and even financial planning tools all under one roof. The company's mission is to help people achieve financial independence. And they've built a platform that competes directly with traditional banks, but with much lower fees and a completely digital-first approach. What makes SoFi really interesting is that they're not just trying to be a niche player. They want to be your one-stop financial solution, and that's a massive addressable market. Now let's talk about the numbers, because this is where things get really interesting. As of their latest earnings report, SoFi has been showing some impressive growth metrics. The company has been consistently adding members quarter after quarter, and we're talking about millions of people who are choosing SoFi over traditional banks. Their product adoption is also accelerating, which means existing customers are using more than one SoFi product. And that is exactly what you want to see, because it increases customer lifetime value and makes the business stickier. Revenue growth has been strong, often beating analyst expectations. And the company has been making significant progress toward profitability. In fact, SoFi has posted GAAP profitable quarters recently, which is a huge milestone for a growth stage fintech company. This shift from burning cash to actually making money has been a major catalyst for the stock. One of the biggest game changers for SoFi was obtaining a national bank charter back in 2022. This might sound like boring regulatory stuff, but trust me, this was absolutely massive. Before getting the bank charter, SoFi had to rely on third-party banks to hold deposits and facilitate lending, which meant they were sharing profits and had less control over their operations. With the bank charter, SoFi can now hold deposits directly, which gives them access to incredibly cheap funding. Think about it. Instead of borrowing money at higher rates to fund their loans, they can use customer deposits that they pay very little interest on. This dramatically improves their profit margins on lending products. Plus, having a bank charter gives SoFi more regulatory credibility and allows them to expand their product offerings even further. This is a structural advantage that very few fintech companies have, and it's a big reason why many analysts are bullish on SoFi's long-term prospects. Let's talk about the business segments, because SoFi operates in three main areas: lending, financial services, and technology platform. The lending segment includes personal loans, student loans, and home loans. This has traditionally been their bread and butter, but it's also the most sensitive to interest rate changes. When rates go up, loan demand typically goes down, which is something we've seen over the past couple of years. However, SoFi has been diversifying away from just lending. Their financial services segment includes SoFi Money, their checking and savings accounts, SoFi Invest for stock and crypto trading, SoFi Credit Card, and other products. This segment has been growing rapidly and is less sensitive to interest rate fluctuations. Then, there's the technology platform segment, where SoFi provides its banking technology infrastructure to other financial institutions through Galileo and Technesis. This is a high-margin business that generates recurring revenue, and it's been a strong growth driver. The diversification across these three segments is actually a strength, because it means SoFi isn't dependent on any single revenue source. Now, no analysis would be complete without talking about the risks, and SoFi definitely has some challenges to navigate. The biggest concern is the macroeconomic environment. If we head into a recession, loan defaults could increase, which would hurt SoFi's lending business. Interest rate volatility is also a factor. While rates have stabilized somewhat, any unexpected changes could impact both loan demand and the value of SoFi's loan portfolio. There's also intense competition in the fintech space. You've got companies like Chime, Robinhood, PayPal, and even traditional banks launching digital offerings. SoFi needs to keep innovating and acquiring customers cost-effectively to maintain its competitive edge. Regulatory risk is another consideration. As a bank, SoFi is subject to strict regulations, and any changes in the regulatory landscape could impact operations. And finally, there's execution risk. SoFi is still a relatively young company trying to disrupt an industry dominated by giants. They need to continue executing on their growth strategy without major missteps. So what about the stock valuation? This is where opinions really diverge. Some analysts think SoFi is still undervalued given its growth potential and path to sustained profitability. Others argue that fintech stocks in general have gotten ahead of themselves and that SoFi's valuation doesn't adequately account for the risks. If you look at traditional valuation metrics like price earnings, SoFi is still expensive compared to established banks. But that's because you're paying for growth. The better way to look at it might be price to sales or comparing it to other high-growth fintech companies. What's really important is the trajectory. SoFi continuing to grow revenue, improve margins, and demonstrate operating leverage? If the answer is yes, then the current valuation could actually be reasonable for long-term investors. But if growth slows or profitability stalls, then the stock could face significant headwinds. Looking ahead, there are several catalysts that could drive SoFi stock higher. Continued member growth and product adoption would demonstrate that the business model is working and that customers are sticky. Further progress on profitability, especially expanding GAAP net income, would attract more institutional investors who have been waiting on the sidelines. Potential interest rate cuts by the Federal Reserve could reignite loan demand and boost the lending segment. Strategic partnerships or acquisitions could accelerate growth in certain areas. Positive analyst upgrades or inclusion in major indices could bring in more capital. On the flip side, any of the risks I mentioned earlier could serve as negative catalysts, so it's important to stay informed and monitor quarterly earnings closely. So here's my take, and remember, this is not financial advice. SoFi is a high-growth, high-risk fintech stock that has significant potential but also comes with volatility. If you're a long-term investor who believes in the digital banking revolution and SoFi's ability to execute on its vision, then building a position could make sense. But I would suggest dollar-cost averaging rather than going all in at once. If you're more conservative or have a shorter time horizon, you might want to wait for more consistent profitability and less volatility. Personally, I think SoFi has done an impressive job transforming itself, and the bank charter is a real competitive advantage. But the stock price will likely remain volatile in the near term based on earnings results and macro conditions. The key is position sizing. Don't put more into SoFi than you can afford to lose, and make sure it's part of a diversified portfolio. Before we wrap up, I want to hear from you. Are you bullish or bearish on SoFi? Do you currently own the stock, or are you thinking about buying? Drop your thoughts in the comments below because I love hearing different perspectives. If you found this analysis helpful, please smash that like button and subscribe to the channel for more stock analysis videos. I post new content every week covering the hottest stocks and market trends. And if you want me to analyze a specific stock next, let me know in the comments and I'll add it to my list. Thanks so much for watching, and I'll see you in the next video. Keep investing smart. And remember, do your own research before making any investment decisions.